Martin Eberhard spent years designing a revolutionary electric sports car, founding a tiny startup called Tesla Motors alongside his early business partner. They needed a massive injection of capital to move from blueprints to a physical prototype, which led them straight to a wealthy tech millionaire named Elon Musk. Elon provided the necessary millions during the initial Series A funding round and assumed the chairman's seat on the young company's board of directors. Within a few short years, Eberhard found himself completely stripped of his chief executive title, relegated to a minor advisory role, and eventually forced out of the building entirely, while his equity percentage was systematically minimized. This wasn't an isolated incident, it is the startup funding trap, and today we will discover how it allows an incoming investor to quietly rewrite your corporate charter and seize your life's work. First, we need to understand the fundamental choice every single entrepreneur makes before a single dollar ever enters the corporate treasury. The sovereign choice. The glossy tech magazines and financial news channels love to celebrate massive fundraising rounds. They treat a $20 million check like a definitive victory celebration for a young company. The reality inside the corporate boardroom looks completely different because those flashy headline numbers always mask severe dilution and massive structural shifts. Every founder stands at a critical crossroads at the very beginning of their business journey. You can choose to build a high-growth venture-scale company, or you can choose to build a highly durable profitable enterprise. Venture capital funds operate with the explicit mandate of securing massive outlier financial returns for their own wealthy backers. They need your startup to achieve an immense scale that enables a massive public offering or a major corporate acquisition. These institutional investors expect to get back 10, 50, or even 300 times their original investment to cover the losses of their other failed portfolio companies. Every single mechanism within the venture capital ecosystem forces your business to chase that explosive hyper-growth outcome. This environment functions exactly like a high-stakes rocket launch, where the ship either reaches orbit or explodes completely during ascent. You are willingly signing up for an intense, high-speed race that dictates your daily operational timeline. The durable, profitable company operates on an entirely different set of operational principles. This business model focuses on steady revenue generation, sustainable customer acquisition, and consistent founder payouts. The business funds its own expansion through its daily sales and avoids outside capital completely. You can think of this path like owning a highly successful commercial property where you keep every single dollar of profit at the end of the month. The founder retains absolute ownership of the equity and maintains ultimate operational control over every major decision forever. This path offers a deep sense of psychological freedom and long-term independence that venture-backed founders rarely experience in their career. Have you ever stopped to consider how much easier it has become to choose the profitable path today? A massive technological shift occurred recently that completely changed the financial math for modern founders. Artificial intelligence tools have made software development incredibly cheap and remarkably fast. A single software engineer using advanced automation can now build products that previously required an entire technical department and $1 million in seed capital. Modern data from platform trackers shows that solo-founded startups now make up more than a third of new companies entering the ecosystem. Skipping the traditional funding gauntlet completely has become an incredibly realistic and highly lucrative strategy in the current market. The funding hierarchy. Outside institutional investment always arrives in distinct chronological stages because professional investors manage their capital risk with extreme precision. They want to see consistent operational milestones before committing more cash to your corporate vision. The journey begins with the pre-seed round, which converts an abstract idea or a basic software prototype into a functioning product. The modern pre-seed landscape has split into two completely separate realities over the past year. Smaller angel rounds frequently stay under $250,000. Larger institutional rounds now average closer to $1.4 million. The vast majority of early-stage deals utilize simple agreements for future equity to bypass immediate valuation arguments. These specific financial instruments allow you to accept capital immediately while deferring the official valuation conversation until a later date. They usually include a valuation ceiling hovering between $10 million and $15 million to protect the early investors from missing out on massive upside. Startups utilizing artificial intelligence intelligence frequently push these ceilings much higher due to intense market excitement and founder competition. The vast majority of standard software companies still raise capital at much more realistic and grounded numbers. The official seed round takes place once your product establishes consistent user traction and clear signs of market demand. Seed valuations climbed dramatically recently, with median post-money figures hitting $24 million. This represents a massive jump from the averages recorded just a couple of years ago. The post-money designation simply reflects the total computed value of your enterprise immediately after the new investor cash clears into your bank account. Startups utilizing artificial intelligence command an immense premium, often securing valuations nearly 40% higher than traditional software businesses. But the criteria for a successful Series A round have shifted significantly over the past few years. The historical rule of thumb dictated that reaching $1 million in annual recurring revenue guaranteed a successful raise. Modern institutional investors now demand closer to $2 or $3 million in annual recurring revenue before issuing a formal term sheet. Your company must show exceptional growth velocity or possess elite technical talent to clear this higher bar. The later rounds focus entirely on hard financial metrics displayed on your operational dashboard, analyzing your exact user retention and unit economics. The dilution loop. Have you ever stopped to calculate how your actual ownership percentage changes when an investor check clears? Many founders mistakenly believe that raising money involves selling a portion of their existing personal stock to an outsider. The corporation actually manufactures entirely new shares and distributes them directly to the incoming investors during the closing process. If you and your co-founder own 50 shares each out of 100 total shares, your initial stake represents exactly half the company. When the corporation prints 20 new shares for an investor, the total share count automatically rises to 120. Your individual share count remains exactly the same throughout this corporate transaction. Your total percentage of the company shrinks significantly as a direct result of this share expansion. You went from owning half the company to owning roughly 41% of it without selling a single personal share from your stash. And this specific mathematical process is known as dilution, occurring automatically during every single funding round you complete. The early history of Facebook provides a perfect illustration of this exact corporate equity mechanic. Eduardo Savarine was an original co-founder of the social network and held a significant portion of the initial corporate stock. As the company scaled and relocated to California, the remaining leadership team decided to bring in prominent Silicon Valley institutional backers. They established a new corporate entity in Delaware and issued billions of new shares to the incoming investors and employees. This massive share creation systematically diluted Savarine's ownership stake from over 30% down to less than 10% in a matter of months. He maintained his original share count, but the massive expansion of the total share pool reduced his overall voice to a corporate whisper. So what does this mean for the long-term future of your startup? Every single time you scale up and welcome a new financial partner, you are signing up for another round of this exact math. The founding team often finds themselves holding a surprisingly small sliver of the corporate pie after 3 or 4 sequential raises. They console themselves with the belief that a small percentage of a massive entity is always superior to total ownership of a smaller enterprise. This logic functions perfectly under ideal economic conditions. The entire equation shatters the moment you encounter a turbulent market or a predatory investor contract. The clauses of absolute control. A highly celebrated headline valuation represents only the surface layer of a venture capital transaction. The specific legal terms embedded deep within the investor contract ultimately dictate who maintains true operational control of the enterprise. By the time a startup successfully secures a Series B round, the founding team's median ownership drops to 23%. This level of severe dilution gives external board members the legal authority to terminate the founder's employment completely. You will require formal board approval for basic decisions like adjusting your own salary or shifting corporate strategy. Many founders fall into a dangerous psychological trap by prioritizing the highest possible valuation number during term sheet negotiations. A founder might celebrate securing a $5 million investment at a $25 million valuation over a lower offer from a rival fund. That higher valuation frequently comes attached to highly restrictive clauses tucked away inside the legal paperwork. The founder ends up making a far worse economic deal due to those hidden structural compromises. Understanding 4 specific contractual terms will will completely protect you from these devastating governance traps. The liquidation preference clause determines the exact order of payouts whenever the corporation experiences a sale or acquisition. The most founder-friendly variation is a 1x non-participating preference, which ensures investors simply recoup their original capital before common shareholders see a dollar. The highly dangerous participating preference allows investors to reclaim their initial investment and then take an additional piece of the remaining proceeds. If you raise $10 million and sell the business for $30 million, the investors absorb their initial $10 million and then claim a percentage of the remaining $20 million. Protective provisions represent another critical set of clauses that grant investors absolute veto power over major corporate actions. The chief executive officer retains their formal title while losing the unilateral ability to sell the company or raise additional capital without board consent. These provisions require explicit investor approval before you can alter the corporate budget, issue new stock, or assume corporate debt. Pro rata rights allow early investors to inject more capital into future rounds to maintain their exact ownership percentage. Drag-along rights compel minority shareholders to participate in a company's sale if the majority desires it, completely overruling the founder's personal wishes. The velocity deadline. The moment investor money clears into your corporate account, a loud invisible clock begins counting down. Investors hand you a check because they expect you to hit massive growth metrics on a highly rigid timeline. Your company operates under a strict operational deadline that influences every single hiring decision and product roadmap. The next major milestone must be achieved before the current pile of cash completely evaporates. Managing this specific timeline determines whether your enterprise survives or joins the massive graveyard of failed startups. The historical rule of thumb suggested that maintaining 18 months of operational cash runway provided an adequate safety margin. The current macroeconomic climate has made an 18-month runway incredibly tight and risky for modern founders. Data shows that companies raising a Series A recently waited over 2 years since their previous funding round. Smart founders now deliberately raise 24 to 30 months of operational runway to avoid pitching investors with an empty bank account. Missing your core revenue targets by month 12 triggers incredibly difficult conversations with your financial backers. Running completely out of money between funding rounds is one of the most common ways a venture startup collapses. Your initial capital was supposed to fund your journey directly to the next major valuation milestone. A critical hire might underperform, or your product development might take twice as long as originally projected. You suddenly find your business 6 months away from insolvency without the financial metrics required to attract new investors. Capital allocators avoid funding businesses that are visibly struggling to survive their current phase. So this desperate position forces founders to scramble for an emergency financial lifeline known as a bridge round. These smaller emergency infusions keep the corporate lights on while you desperately attempt to fix your operational issues. A bridge round negotiated under heavy pressure always carries severe penalties like lower valuations and extreme dilution. The market has split into two vastly different realities based on the underlying technology of your business. Standard software companies face an incredibly brutal fundraising environment that demands immense proof of capital efficiency. The capital efficiency shift. Highly hyped artificial intelligence startups are operating in an entirely different financial universe. Data indicates that artificial intelligence companies secure much larger rounds and higher valuations at every single stage. The median valuation for an artificial intelligence company tracks nearly 40% higher than its traditional software counterparts. Investors compete aggressively to fund any team that possesses a legitimate technical advantage and rapid revenue growth. The average software business faces a much steeper climb than founders encountered during the peak of the recent tech boom. The modern landscape requires a complete mindset shift regarding how you evaluate early agreements. Most pre-seed companies now utilize simple agreements for future equity, which delays the official valuation process. Data shows that over 90% of early rounds utilize these instruments to move quickly. The long-term risk involves the eventual conversion of these agreements into actual company shares during the next major funding round. The valuation caps and discounts negotiated at the very beginning ultimately dictate how much equity equity the founder surrenders. So how do you successfully manage your cash position when the market shifts so drastically? You need a highly centralized financial dashboard that tracks your true operational expenses in real time. Many early-stage startups collapse because their spending habits slowly creep upward without anyone noticing the aggregate impact. Subscription software fees, marketing experiments, and freelance contracts accumulate across multiple disjointed bank accounts. A founder can easily miscalculate their true survival timeline by tracking their financial health on a delayed quarterly basis. The sovereign entrepreneur. The harsh reality of the venture capital ecosystem forces a complete mindset shift for the modern entrepreneur. You must stop viewing a massive funding announcement as a sign of personal wealth or ultimate business success. A funding round represents a significant sale of corporate governance and a firm commitment to an unrelenting growth treadmill. You are choosing to place your entire corporate destiny into the hands of an external board of directors. The historical story of Martin Eberhard at Tesla serves as the ultimate warning for every single founder in the audience. He poured his entire life into building a global transportation powerhouse from scratch over many grueling years. The major institutional investors he welcomed into his capitalization table eventually turned against his leadership during an operational transition. They utilized the specific voting rights and protective provisions inside their early contracts to demand his immediate resignation as chief executive officer. The governance structures he signed off on during the exciting early days became the same tools used to oust him entirely. Once you accept venture capital, institutional governance always supersedes personal founder authority.